discussion on today's market, I want to bring in Ed Siddell, CEO and Chief Investment Advisor at EGSI Financial. Ed, it's great to see you. I don't know if Dwayne "The Rock" Johnson can infuse some momentum into these stocks today, but we do see a mixed market as The Rock is down here on the floor of the NYSE. Record highs, in fact, this year for the Dow and the S&P. What's your thoughts on the outlook for stocks?
Well, thanks for having me back. And as the saying goes, as January goes, so does the rest of the year. I think I'm very cautiously optimistic for this year for a whole host of reasons. And the main reason why I'm optimistic, I think we're in a bull market. But a lot of that has to do with the election year. Historically, election years are always a little bit more positive. With rates looking like they're going to come down, the Fed's already said back in August they're going to lower rates 3 times. I think that's probably going to start happening in May. I know the market and a lot of folks have been anticipating 6 to 7 reductions in interest rates starting as early as March. I don't think that's going to happen. But we're already starting to see revenues up because of price increases. I think earnings are going to stay somewhat steady for the rest of the year, and those companies with strong balance sheets and a lot of cash on hand are going to fare very well. And I think the tech sector is going to continue to outperform this year. We saw that yesterday.
So it's interesting, Ed, because one factor, of course, that's different this year than what we've seen in years past. There are a variety of them, but it is an election year, right? A big election year, in fact, for the presidential race. Traditionally, we have seen that actually bode well for the market. Do you think that's the case this year?
I do. We're already starting to see the effects of the election year. Gas prices started to go down significantly. They kind of bumped back up, but as a whole from, the last 18 months, they're down significantly. We're already starting to see interest rates down significantly from the high in October. It's all about the economy, pain at the pumps, what people are feeling, and that's consumer sentiment. And we saw that report come out last Friday, so people are feeling better than they were this time last year. And that always has an impact, not just on the election, the outcome of the election, but the markets as well. So the markets are feeling positive as a whole. But again, there's so many outliers that we need to be very, very cautious, between now and, through the end of the year.
Are there any economic factors, Ed, that still are unresolved for you, right? I think inflation might be one of them. We'll see how that data plays out. But any sort of potentially wild cards that could impact the economy and thus the stock market?
Yeah, so, let's talk about inflation first, because when, everyone keeps saying inflation is coming down, inflation is not coming down. It's the rate of inflation that's lowering. Prices are still going up. All right, so we're still having an increase, but it's down significantly, at least the growth rate from 9% down to, just a little over 3%. So prices are still going up. As prices increase, that's inflationary. As we continue to spend more than what we have, which is the second thing, is debt. I mean, the national debt that we have is over $34 trillion. The unfunded liabilities from Social Security to Medicare and Medicaid, defense spending, just carrying the interest on the debt, it's estimated that is in excess of 180 trillion plus the 34. So there's a debt bubble. You add that to all the consumer debt. Consumer debt is at an all-time high. So at some point in time, it's going to come home to roost. I think that may happen after the election, but those are the outliers. Not to mention some of the geopolitical strife that the proxy wars that we're fighting right now that could actually tip the apple cart.
So we did have the University of Michigan reporting the highest consumer sentiment numbers that we had seen since 2021, before inflation really became a factor, obviously taking this market lower. Kind of the same time, actually, that the stock market was last at a record high. What do you think is behind that? Do you think it is the new records that is fueling this new consumer optimism?
Maybe a little bit, but I think the big factor is, just everyday living, pain at the pumps. The gas prices are going down, interest rates are going down, and that has more of an impact because not only does that affect, housing costs, rental costs, auto purchases, and credit cards. So, I think that's why sentiment is as high as it's been in the last couple of years. It's because the difference between at the end of the month between what they made and what they're spending and what they have left, it's getting a little bit bigger because, when you're paying $1 or $2 less a gallon, that has a huge positive impact on the average family.
Well, we know heavy hitters, especially in this tech space, like Microsoft, set to report earnings. Microsoft will be
Yep.
today. Do you think that this AI boom that certainly benefited the NASDAQ, rising 42% last year, can still continue in 2024?
I do. I do. I mean, if we look at NVIDIA, yesterday, it was approaching, an all-time high, $600 a share. From just a couple years ago at 128 a share, and I think it is going to continue. When you have Microsoft, it is going to continue to grow, but then you have Google that has a lot more room for growth in that AI space. So I think the AI, the tech sector is going to continue to grow this year.
All right. And my final question, of course, is any other sectors on your radar, ones that might benefit from lower interest rates as the Fed is forecast?
Yeah, well, so we're talking about AI. I do like that. Healthcare has been beat up tremendously, over the last 12 to 18 months. And with our aging population, I do like healthcare and pharmaceuticals, but industrials. As we have lower interest rates and that continues, those revenues, it's going to create higher earnings for those companies, and I think that that's a diamond in the rough this year for sure.
All right, Ed Siddell, we appreciate it. A day where maybe the Dow will join the other two major indexes in the green. Ed's the CEO and Chief Investment Advisor at EGIS Financial.